The number is 38.4 trillion. As of January 2026, the United States gross national debt has reached a velocity that defies traditional economic modeling, increasing by over $2 trillion in just 12 months. This is not a conspiracy theory. This is math. While the public is distracted by political theater, a silent, systemic betrayal is unfolding within the Federal Reserve. We are witnessing the final, aggressive erosion of the dollar's purchasing power, a deliberate devaluation designed to liquefy a debt load that can no longer be serviced through tax revenue alone. If you hold a savings account, a 401k, or a pension, you are the primary casualty of this exit strategy. The great 2026 betrayal is the moment the Fed admitted, through its actions, that your life savings are the collateral for the government's insolvency. You must watch this right now because the mechanism of wealth destruction has shifted from gradual to exponential. The math is absolute, and the return to a gold standard reality is no longer a choice. It is the only remaining escape hatch for a system that has finally run out of time and trust. The cracks began appearing not in the headlines, but in the plumbing of the global financial system. Throughout 2025, the 10-year minus 2-year Treasury yield curve remained stubbornly inverted, signaling a fundamental misalignment between current monetary policy and long-term economic viability. While the Federal Reserve maintained a restrictive Fed funds rate to combat persistent inflation, the liquidity in the overnight repo markets began to dry up, forcing a quiet resumption of quantitative easing under the guise of market stability. This is the classic invisible crack, a divergence where the Fed's public stance on fighting inflation is undermined by its private necessity to provide liquidity to a collapsing banking sector. The M2 money supply, which had briefly contracted, surged back to life as the Treasury Department, led by Janet Yellen, ramped up the issuance of short-term T-bills. This deluge of debt has created a paradox. The more the government borrows to keep the system afloat, the less the underlying currency is worth. We are observing a structural failure where the primary dealers, the big banks like JP Morgan, are increasingly hesitant to absorb the excess supply, leaving the Fed as the buyer of last resort for a nation that is effectively printing its way into oblivion. The crisis mechanism is now fully operational, functioning as a feedback loop of debasement. When the Fed is forced to monetize the federal deficit to prevent a sovereign default, it triggers a stealth devaluation of the dollar. As the Treasury issues trillions in new debt, the supply of dollars in the system increases while the actual productivity of the American economy remains stagnant. This results in a sharp, inescapable rise in the Consumer Price Index, CPI, and the Personal Consumption Expenditures Index, PCE, which the Fed can no longer hide behind hedonic adjustments or base effects. The mechanism is simple but lethal. Higher interest rates are required to attract buyers for U.S. debt, but those same high rates make the interest payments on that debt impossible to afford. To bridge the gap, the Fed prints more, which drives inflation higher, which in turn requires even higher rates. We have entered the debt spiral phase of the collapse. For the average American, this means the Fed is trapped between two catastrophic choices: let the entire banking system collapse under the weight of bad debt, or destroy the value of the currency to save the institutions. They have clearly chosen the latter, betting that you won't notice the theft until your purchasing power is gone.
History does not repeat, but it certainly rhymes with the precision of a funeral march. The current trajectory mirrors the terminal stages of the Weimar Republic's hyperinflation in the 1920s and the lead-up to the 1929 Great Depression. Much like the 1920s, the current era has been defined by an unprecedented expansion of credit and a disconnect between asset prices and economic reality. However, the most chilling comparison is the 1971 Nixon shock, where the U.S. formally abandoned the gold standard. Back then, it was a tactical move to handle the costs of war. Today, it is a desperate survival tactic for a global hegemon that has over-leveraged its future. We see the same patterns that preceded the 2008 Lehman Brothers collapse: rising delinquency rates, a frozen credit market, and a central bank projecting confidence while privately panicking. But unlike 2008, there is no too-big-to-fail bailout that can fix this, because the entity needing the bailout is the U.S. Treasury itself. We are looking at a 1929-style contraction of real wealth coupled with a Weimar-style inflation of prices. The logic of the 1944 Bretton Woods Agreement has been exhausted, and we are now reliving the exact conditions that forced the world to return to hard assets in previous centuries. On Main Street, this macroeconomic betrayal translates into a visceral struggle for survival. The American dream has been repossessed by the very institutions sworn to protect it. Mortgage rates, once a path to home ownership, have settled at levels that make housing a luxury good for the elite, while the cost of living, from groceries to energy, has decoupled from wage growth. U.S. households are now carrying record-breaking levels of credit card debt just to maintain a standard of living that was once affordable on a single salary. The middle class is being hollowed out by a hidden tax that no one voted for: inflation. When the Fed devalues the dollar, they are effectively seizing a percentage of your labor and your future. Your savings account is no longer a store of value, it is a melting ice cube. The psychological impact is profound, as the sense of security that underpinned the American social contract evaporates. As the cost of debt service for families exceeds their discretionary income, the velocity of money slows, leading to a stagflationary environment where prices rise while the economy dies. This is the personal cost of the Fed's gamble, a generation of Americans realizing that the rules they played by have been rewritten in the middle of the game to favor the creditors. The betrayal is not confined to U.S. borders. It has triggered a seismic shift in the global geopolitical order. For decades, the U.S. dollar's status as the world's reserve currency allowed the Fed to export its inflation to the rest of the world. But that exorbitant privilege has reached its limit. We are witnessing an aggressive move toward de-dollarization as the BRICS Plus nations and other major economies recognize the dollar is a liability, not an asset. When the Fed makes your savings worthless, it also makes the dollar-denominated reserves of foreign nations worthless. This has led to a coordinated retreat from the U.S. Treasury market. The geopolitical consequence is a world splitting into two financial blocks, one tied to the fiat debt of the West and another anchored by tangible commodities and gold. As the demand for dollars drops internationally, those dollars return home, further fueling domestic inflation in a reflux effect. The weaponization of the dollar through sanctions has only accelerated this divorce. The U.S. is losing its ability to dictate global terms because it can no longer guarantee the value of its currency. The era of dollar dominance is ending, not with a bang, but with a global scramble for the exits, as sovereign nations trade their T-bills for physical bullion.
In this environment of systemic failure, the strategy for the individual must shift from growth to preservation. This is the pivot to wealth sovereignty. When the fiat system betrays its holders, the only logical response is to return to assets that cannot be printed, debased, or canceled by a central authority. Gold and silver are not just commodities, they are the only forms of money that have survived every central bank collapse in human history. For the first time in over 50 years, the gold standard is returning, not by government decree, but by market necessity. Simultaneously, Bitcoin has emerged as digital gold, a decentralized supply-capped alternative for a digital age. Self-sovereignty is the goal. This means moving assets out of the traditional banking system and into hard assets. Investors must hedge against the collapse of the dollar by holding physical metals and censorship-resistant digital assets. Diversification no longer means a mix of stocks and bonds, it means a mix of counterparty-free assets. The betrayal of 2026 is a signal that the era of passive investing in a manipulated market is over. To survive, you must become your own central bank, holding assets that represent real value in a world of paper illusions. The ultimate conclusion of the great 2026 betrayal is a philosophical reckoning with the nature of capitalism itself. We are seeing the end stage of a century-long experiment in central planning and fiat currency. This is the moment where the social contract of money is broken. If money is the medium through which we exchange our time and labor, then a corrupt currency is a corruption of human life. The return to a gold standard reality is a return to honesty, a system where you cannot spend what you do not have and you cannot print what you have not earned. This transition will be painful, marked by volatility and social unrest, but it is a necessary purging of the excesses that have crippled the global economy. The future of capitalism belongs to those who embrace transparency, scarcity, and decentralization. We are moving toward a world where value is proven, not promised. This video is your warning and your roadmap. The writing is on the wall, and the window to protect yourself is closing. Subscribe and stay informed as we track the collapse of the old guard and the rise of a new, sovereign financial era. The math has made its choice, now you must make yours. The architecture of this betrayal is built upon the systemic manipulation of interest rates, a tool the Federal Reserve has used to create an artificial sense of prosperity. By suppressing rates for over a decade, the Fed encouraged a culture of malinvestment, where capital flowed not into productive enterprises but into speculative bubbles. Now, as the 10-year, 2-year Treasury yield remains a harbinger of doom, the cost of that cheap money is being collected. Every percentage point increase in the Fed funds rate today acts as a tightening noose around the neck of the American corporation. We are seeing zombie companies, those that only exist because of low-interest debt, begin to default in record numbers. This is the liquidity trap in action. As these companies fail, they take with them the jobs and pensions of millions of workers. The Fed's attempt to engineer a soft landing has instead created a hard vacuum where capital is fleeing the productive economy in favor of government debt that is being debased as fast as it is issued. This is the redistribution of wealth in its most cynical form, from the productive to the political.
The role of big banks like J.P. Morgan in this transition cannot be overstated. These institutions serve as the gatekeepers of the Fed's liquidity, but their interests are no longer aligned with the stability of the domestic economy. In the 2026 landscape, we see a consolidation of banking power that rivals the money trust of the early 20th century. As smaller regional banks collapse under the weight of commercial real estate losses and the rising cost of deposits, the too-big-to-fail giants are absorbing the remains, backed by implicit guarantees from the Treasury. This centralization of financial power is the precursor to a central bank digital currency, the ultimate tool for monitoring and controlling personal wealth. By making your life savings worthless through inflation, the system prepares you to accept a new digital dollar that comes with strings attached. This is not just an economic shift, it is a move toward total financial surveillance. The banks are not your partners in wealth creation. They are the infrastructure through which the Fed executes its devaluation, ensuring that while the currency dies, the institutional control remains absolute. To understand the magnitude of the great 2026 betrayal, one must look at the divergence between the M2 money supply and real-world scarcity. For years, the Fed operated under the delusion that they could print infinite amounts of currency as long as it didn't immediately show up in the CPI. But the laws of economics are patient, not absent. The massive expansion of the monetary base has finally caught up with the reality of finite resources. This is why we see the cost of essential goods, energy, food, and shelter skyrocketing, while the quality of life for the average citizen plummets. The Fed is essentially engaging in a margin call on the American standard of living. They are paying off the national debt with the purchasing power of your future labor. This is the math of a decaying empire. When the currency loses its function as a reliable store of value, the social fabric begins to fray. Trust, the invisible glue of any economy, is the ultimate casualty. Once the public realizes that the Fed is not fighting inflation, but is actually the primary source of it, the transition to alternative systems, the gold standard and decentralized finance, becomes an unstoppable grassroots movement. The survival strategy for the modern investor requires a fundamental shift in mindset. You must move from a yield-seeking posture to a risk mitigation one. In a world where the Fed is actively destroying the value of the dollar, a 5% return on a T-bill is actually a net loss when adjusted for the real rate of inflation and currency debasement.
True wealth preservation in 2026 involves hard assets and zero counterparty holdings. This means physical gold and silver stored outside of the banking system and Bitcoin held in self-custody. These assets represent exit ramps from a failing fiat experiment. They cannot be frozen by Janet Yellen's Treasury, and they cannot be inflated away by Jerome Powell's Fed. Furthermore, self-sovereignty extends to your geographic and digital footprint. Diversifying your jurisdictional risk and ensuring you have access to non-inflationary mediums of exchange is no longer a prepper fantasy, it is basic financial literacy. The betrayal of 2026 is a wake-up call that the institutions we were taught to trust are now the greatest threats to our financial security. Positioning yourself outside of their reach is the only way to ensure that your life's work isn't erased in the final act of this debt-fueled tragedy.
As we stand at this precipice, we must realize that the great 2026 betrayal is the end of a long, unsustainable road. The Fed's attempt to play God with the global economy has failed, and the bill has finally come due. But in every collapse, there is the seed of a new beginning. The return to a gold standard, whether through formal government return or through a decentralized, market-led adoption of hard assets, represents a return to economic sanity. It is a future where your savings have meaning, where your labor is respected, and where the value of a dollar is not subject to the whims of a committee in Washington. The era of easy money is over, and the era of sound money is being born out of necessity. You have been warned, and you have been shown the data. The math is absolute, and the writing is on the wall. The question is no longer whether the system will fail, but whether you will be standing in the rubble or building on a new foundation. Secure your future, move into hard assets, and take control of your financial destiny. Subscribe to stay ahead of the curve as we navigate the greatest transfer of wealth in human history. The betrayal is here. Don't let it be yours.